Next, we are going to pay attention to our internal operations, specifically managing our human resources and our production. Let's talk about human resources first. Job satisfaction is one of the real drivers of employee productivity. And so we need to figure out how we increase job satisfaction to increase productivity to help us lower our cost of production. Job satisfaction is determined in part by the compensation package. And the compensation package is driven by wages, health benefits, vacation time, and pension contributions. Usually the assumption is that more compensation leads to more job satisfaction. At this point, you know already, because of quarters 1 and 2, that your location of a factory had a certain relation of benchmark salary compared to other locations. Now we work compared to a status quo of quarters 2, 3 and see how we can improve our productivity in the location that is fixed by adjusting the human resources benefits. More compensation, of course, leads to higher cost, but that higher cost may actually increase effectiveness of your production or productivity so much that in the end effect, your increased cost creates a net benefit in your productivity for your firm. That's, of course, only human resources. In production, in your operation of production, we have another conundrum to deal with. It is inventory versus cash. If you have really large production runs, that lowers your unit cost of production. However, large production runs might mean that you have too much inventory. Large volumes of inventory, as you'll figure out in our simulation, lead to a lot of cash that is bound by inventory. In addition to that, you have the risk of brand obsolescence because of developments by competitors that makes your brand no longer competitive in the marketplace. And if you have the wrong product in the warehouse because your brand is obsolete, you will have to actually discard it at a loss. So the benefit of low production costs with large runs is to be debated against the risk of too much inventory based on how much cash you bind, as well as if you haven't sold everything in the quarter, will the brand be obsolete next quarter given the competitive reaction in the marketplace? Let's look at the opposite end. If we look at low production, yeah, you have low cash requirements because your inventory is usually less. Unfortunately, it means also that you have higher per unit production cost. Is there a risk of too little inventory? Yes, there is. You can have stockouts. That means your customers want to buy your product, you have no product in inventory, and customers might have the need to buy the product at that time. And they're not going to wait for the next quarter, but they're going to go for the next best computer. That means your stockout means you lost the sale. Your competitors get the sale for free, because even though they were not first choice, given the fact that you couldn't satisfy the customer need, they're getting one for free. Of course, stockouts, which means customers going to competitors means lost revenue. But in addition to that, it also means customer ill will. Your customers will be unhappy. And as we know from social media today and customer reviews on websites, if your customer's unhappy, they might be vocal about it and might actually spot some information to others, which will actually have a word of mouth effect and make other customers or potential customers wary of your firm. So we really look at a razor's edge here between too much production run, too high of a production run, or too low of a production run. The operations managers that you have in your firm are really going to be challenged to figure the optimum. There is another complexity here, and that is projecting demand, because you only want to really produce as much as you need for the demand you expect. How do we project demand in the simulation at the beginning? We can probably assume that a salesperson sells between 30 and 100 units each per quarter. Now, in the beginning, with very few customers in quarter 3, that will most likely be at the lower end. In the later parts of the simulation, you might be at the higher end, and you then have an idea on how many salespeople you have to have when you're in full-fledged market motion. Demand is also a function of market potential in your segment. And of course, the quality of your marketing decisions. For example, the advertising strategy and the pricing strategy along with your design. So, on average, salespeople will sell around 50 units each for the entire first quarter of the test market. But again, that can range from 30 to 100 depending on number 1, the segment you chose and the market you chose, and number 2, your marketing and product decisions or the competitors who are competing with you in quarter 3 in the market. So, as we just said, there is a number that we can deal with, 50 per quarter per salesperson, that gives us some indication of projecting demand. How do we schedule operating capacity? So we have a forecast of total demand for the quarter, but we also have to make sure that we adjust for less than perfect productivity and effectiveness. So maybe we should add approximately 30% for low factory worker productivity, and maybe we should add 30% more for long changeover time if we have 2 brands, which we do. So let's assume that we have 10 salespeople and we assume that each can sell 50 units. The probable demand for the quarter would be about 500 units. However, we look at 30% based on lower worker productivity. That means 150 units more should be produced, given the fact that we lose 30% due to lack of productivity. And then we said about 30% for a long changeover. That means another 150 units for long changeovers. So in other words, if we want to have enough for 500 units to be sold in the quarter, we probably have to set the operational capacity at 800 units for the quarter to actually be able to serve the 500 units that we forecasted. Changeover is really important, not only because you will not stay at 2 brands, but it is also one of the most expensive production costs. Changeover means that you're losing time of production due to changing from one brand to the next brand that needs to be produced. And of course, there are some tensions that we have to deal with. Marketing wants as many brands as possible to satisfy as many segments as they envision they want to satisfy in the marketplace. However, brands with diverse components force long changeover, and thus we have lower production utilization and higher production cost. So therefore, manufacturing wants fewer brands in order to allow for long production runs and lower production cost. By investing in research and development to improve changeover, you can actually get it both ways, have it both ways. By investing R&D to improve changeover, you can have more brands and lower production cost because you have invested in technology and equipment and materials and procedures so that your changeover cost will be a non-factor for your production. The goal would be mass customization. See our good friends at Dell, that you can create many brands for many segments and you don't have to fear the changeover cost, given the fact that you invested enough in research and development to drive changeover costs down. Next, we are looking at replenishment and target points. A target point is the maximum number of units in the warehouse and does not have much of an effect until Q4 or later. Remember, we are in a test market. The replenishment point is the minimum number of units in a warehouse. When the inventory of a brand drops to that minimum number, to that point, it is a signal to the plant manager to do a changeover and start production as soon as possible. In other words, the replenishment point is one of the learning points for Q3. Lower numbers in replenishment cause shorter production runs. That means more changeovers and higher production cost. Lower inventories and more stockouts, with all the effects that I just explained before. Higher numbers have the opposite effect. They can lead to higher stockouts if the replenishment point is set too high. This is because the length of time between changeovers is longer. Until you gain more experience in the simulation, it's probably a safe value for the target point to be at 100 and a safe value for the replenish point to be at the range between 50 and 20 to 50. However, as we are moving forward in quarters 3, 4, 5, that replenishment and target points is one of the most important optimization points for your production manager. Last but not least, let's talk about the financials. You need to project pro forma cash flows. That means you enter all decisions and have therefore the financial component of each decision that is posted in the pro forma cash flow. You need to run the factory simulation. The simulator will estimate production costs and revenues. You load the data into the pro forma cash flow, and you check your ending cash position. A desired ending cash position should be at 500,000 or more. That is important. If you run it the first time, you'll be surprised. You are finding issues with your decision making, and you probably have to change some of your decisions, some of replenishment points, etc., because you're running out of money. Therefore, doing a projected pro forma cash flow with the factory simulation is absolutely mandatory for all groups to do before they submit their decisions. In Q3, you should probably prepare a pessimistic scenario. So run multiple projections for cash flow. Run one as you decide you would expect. Run one at a pessimistic scenario with reducing the demand by 50% while you keep all the other expenses the same. Rerun the simulation, the factory simulation, reload the pro forma cash flows, and look at the pessimistic scenario ending cash balance. Make sure you're at about 300,000 or more. And then you might even look at the worst case scenario. Put the demand at a quarter of your expected sales and look at the numbers and look how bad it would be. While you're probably thinking at this point, why am I doing that? It is extremely important because you do not want to run out of cash with an emergency loan by the loan shark at the beginning of the simulation. It will really put you on a negative trajectory from which you will have a hard time to recover during the simulation. And remember, you expect net losses and negative cash flows at the beginning, but you can't overdo it. You cannot go bankrupt in the beginning because you don't run your simulations and your pro forma cash flows, so you know what's going on. Last but not least, in quarter 3, it's really important to link your tactics to strategy. Your strategy follows from the objectives that you have determined for your firm. Your tactics follow from the strategy. Make sure that every tactic supports your overall strategy, and make sure that your tactics are consistent and coordinated within and between all the functional areas. To conclude, the learning points for quarter 3 are really tremendous. They are as important as they can be to go forward. Number 1, try to really execute a coherent strategy. Make sure you manage your cash in the face of great uncertainty so that you have at least 300,000 under the pessimistic sales scenario. In other words, learn before you run. Marketing strategy. You need to coordinate a host of tactics: sales, advertising, pricing. Making sure you're balancing your cost, potential profit with what the market will bear and the competition. As I said before, you're testing the market. You're trying to discover the market's response functions for many of your actions. Production. Try to learn how to manage capacity inventories and costs to meet demand-based goals. And human resources. Try to manage the financial and personal needs of your employees and make sure that you have a bottom line understanding of what that means for your firm. Don't overpay and be too costly, but do motivate enough so that your productivity for the firm increases and leaves you with a positive bottom line. As I said before, you need to make sure that you have an ending cash flow that is positive, while we know that your operating profits will most likely be negative.